Investors, I don't know a single dividend investor, let alone an investor in general, who doesn't like getting paid every single month for doing absolutely nothing. So in today's video, I have 4 prime monthly paying dividend ETFs that dividend investors should not be shrugging off or ignoring. Now, if you're new here, I'm Ari, a dividend investor on YouTube with a very simple mission of delivering through on economic insights to help you understand the market and dividend stock ideas as they become ripe to buy. But with all of that out of the way, enough talking, let's dive right in. As mentioned, today we're going to run through 4 monthly paying dividend ETFs that will not only help you build a solid investment portfolio foundation, but of course reward you monthly. But before we cover the ETFs, I want to share the importance of number 1, investing into an ETF and building a portfolio foundation, as I like to call it, and number 2, why monthly paying ETFs aren't ideal over, say, quarterly paying dividend stocks or ETFs. So first, let's cover the why as to why we should all be investing into an exchange traded fund, at least to start and ultimately maybe then forever. And the answer, it's simple. An exchange traded fund allows an investor to ultimately invest into a basket of stocks as opposed to an individual stock, which means you don't have to worry much about picking the best of the best dividend stocks or worry when the market wavers, as ETFs grant you an added measure of security and moreover emotional ease in knowing that even if one stock goes down, the others will continue to perform. Now, as for the why a monthly paying dividend ETF, easy. Money in your pocket today is better than money in your pocket tomorrow. And this is not to say that some of these funds that pay quarterly aren't as good, but getting paid every single month can certainly help you on your journey, especially if you're not reinvesting the dividends. Though in my opinion, depending on the market, dividends should always be reinvested, but more on that in a video to come. Now let's get to our very first paying dividend ETF. It is none other than the Wisdom Tree High Dividend ETF, ticker symbol DHS, which seeks to track the investment results of high yield dividend companies specific to the US equity market with targeted exposure to some of the highest yielding companies. And with over 1.19 billion in assets, with a current count of 392 equities within the fund, we are talking about a dividend powerhouse here, with some of the top holdings being ExxonMobil, AbbVie, Chevron, Philip Morris, and Altria. As we speak, the fund is down on the year, currently trading for $78.41 per share. That's almost 8% down on the year to date, which presents an opportunity for us all as investors, as analysts see about 20% worth of upside, with the share price rising to $93.56 per share. Now, looking into the fund's track record, if you invested $10,000 into this fund 10 years ago, your $10,000 would have more than doubled to $20,598, with the fund's average annual return of 8.21%, and the average dividend yield coming in at 4.31%. But get this, returns as such will only cost you roughly $38 per $10,000 invested, given the rather low expense ratio for the Wisdom Tree High Dividend ETF at 0.38%. Moving right along to our second monthly paying dividend ETF, let's talk about Invesco S&P 500 High Dividend Low Volatility ETF, ticker symbol SPHD, which is based on the S&P 500 Low Volatility High Dividend Index, with at least 90% of its total assets in common stocks that comprise of the index. In other words, we're talking about 51 securities traded on the S&P 500 that historically have provided some of the highest dividend yields and give investors added security given the minimal volatility, as the fund is rebalanced semi-annually to ensure its consistency. Now, as for the fund's leading securities, we have holdings like Altria, Verizon, AT&T, Kinder Morgan, and Dow. And all in, the Invesco S&P 500 High Dividend Low Volatility ETF totals over $3.29 billion in assets, which work with one another to deliver shareholders of this fund with a 4.27% dividend yield. But let's talk about the fund's performance, because investing $10,000 10 years ago would have allowed you to pocket more than $12,000, totaling $22,890, given its 8.22% annualized returns, which is not too shabby considering you'd only have to pay the expense ratio here at 0.3% meaning that's $30 per $10,000 invested. Now, before we get to the next monthly paying dividend ETF, let me know if this content is of any value to you by simply tapping on that thumbs up button so I can continue to make similar videos to this one. And most importantly, in order to never miss a video, make sure you also subscribe to the channel as well. Now, where were we? Yes, let's talk about the JP Morgan Equity Premium Income ETF, ticker symbol JEPI, which takes from the expertise of some of JP Morgan's finest to invest into equities and equity derivatives to ultimately try and invest defensively through a bottom-up fundamental research process with the stock selection based on risk-adjusted stock rankings and call options. But let me put it simpler for you. JEPI is a large fund that has gained a lot of popular interest recently and very quickly, as it has grown to ultimately $21 billion in assets under management since inception back in 2020. Now, JEPI is quite diversified with 117 total holdings, with its top holdings making up 17.9% of the assets and the top 5 breaking down to US cash, followed by Microsoft, the Hershey Company, MasterCard, and Amazon. So plenty of defensiveness with a solid offense and growth investments as well for the low cost of $35 per $10,000 invested, given the expense ratio is coming in at 0.35%. And although we cannot go back 10 years ago, given the fund's creation in 2020, we can see that it generated plenty of growth, roughly 44% in terms of a share price, meaning if we invested $10,000 in 2020, we would already be sitting on $14,415, and we would be able to continue to collect on JEPI's monthly dividend yield coming in at a whopping 11.26%. And last, but certainly not least here, let's talk about a similar fund to JEPI in terms of the approach. It's the JP Morgan NASDAQ Equity Premium Income ETF, ticker symbol JEPQ, which focuses on the NASDAQ 100 stocks and is also a fairly new ETF that launched in 2022 following JEPI's success. Now, when it comes to JEPQ, we're talking about generating income through a combination of selling options and strategically investing into large cap US-based growth stocks. That means more volatility, even though the fund itself aims to minimize the volatility with selectivity on the NASDAQ picks. So we shouldn't be too surprised in seeing that the fund is actually wavering amidst the current economic conditions, whereas it's trading for $46.74 per share, yet up overall in the year by 19.75%, which makes sense given its 80 holdings that total over $2.88 billion in assets under management, with Microsoft, Apple, Google, Amazon, and Nvidia making up the top 5, which have all been flourishing rather recently. And while JEPQ, like JEPI, is a newer fund, we cannot go back 10 years ago, but we can go back to earlier this year to discover a $10,000 investment would have allowed us to sit on a profit of nearly $2,000, totaling $11,975.40. And we can collect on the strongest dividend yield year, coming in at 12.11%. Now, investors, there you have it. From DHS and SPHD to JEPI and JEPQ, the 4 high dividend ETFs that pay monthly dividends that will allow you to get invested right now and immediately begin to enjoy all of the passive income. But for now, I have to know, which of these dividend ETFs do you own? Or if you don't own any of them already, which ones caught your attention? And even more importantly here, do you even think monthly paying ETFs matter? Or are you sticking with the quarterly paying ETFs? Drop all of your thoughts down in a comment down below, and don't forget, as we grow this channel together, your help in tapping on that thumbs up button means a lot to me and goes a long way. And if you're not already subscribed, make sure to join me now by simply tapping on that subscribe button as well to never miss a video. Now, investors, with all of that said, I will see you in my next video.